Is this stock market on the brink of a massive crash in 2024? With the market showing signs of turbulence and the crash rumors all over the place, this could be one of the most important videos you will watch this year. So, is there anything you could do to benefit from these market crashes in a smart way? When you would ask one of the most legendary investors, Jack Bogle, who has been in the financial industry for over 60 years, his answer would be something like this.
I think basically you should not be doing anything differently. I mean, investment is a pretty simple thing. Investment is owning businesses, or I would say, being an inveterate index fund person, owning all of American business, owning every company in America, letting capitalism do its work. Those companies will grow at probably around 7% a year. They'll pay you about a 2.5%, somewhat lower than history, but a 2.5% dividend yield. And that should, over time, bail you out of anything that happens because of the wild swings. I mean, if you visualize investment as growing in kind of a steady line, which it does, and visualize the crazy market as being all these jags up and down around this steady line, upward, always upward, I think, then you've got to say, I know I'm not smart enough to get out at the high. I know I'm not smart enough to get back in at the low. So I'm just going to stay the course, as we would say at Vanguard, and hang on through all that. And importantly, if I'm trying to accumulate money for retirement, or to buy a home, or to educate my children, what you want to do is keep investing. And say, how can I keep investing the day that the market goes down 600 points? That's the greatest time in the world to invest. It's certainly better than doing it the day before it goes down 600 points. And I think people have lost sight of the fact that a sharp market decline is, of course it's bad for sellers, but it's good for buyers. And since the stock market is the interaction of sellers and buyers, it's always good for somebody. Right. How much do you want in stocks and how much do you want in bonds? To me, that is by and large a buy and hold proposition. Don't do something, just stand there, almost no matter what happens, and maybe no matter what happens. For example, even this 50% decline. You ended up with more money 7 years later, from 2007 to 2014, if you just stayed in and just taken your lumps, and it came back if you were in an all market index fund. So asset allocation is a little different, but there's one thing that is the same. Please don't let anybody forget this. If you're smart enough to reduce your allocation to stocks and increase your allocation to bonds, somebody else is reducing their allocation to bonds and increasing their allocation to stocks.
The logic is the same.
And the logic is identical. So if the system is roughly, which it is, depending on how you count the Treasury's debt, which is another interesting story, but roughly a 60-40 situation. So you have the total market allocation for the typical investor, and the variations are not huge. Somebody's going to be 100% in equities, which by definition is the best long-term strategy, and yet you may not be able to handle the bumps. Well, let me correct myself. No, 100% equities is not the best long strategy. 100% equities leveraged, 2 to 1,
there you go.
3 to 1, just so long as you get someone to bail you out at the bottom,
right,
and you can pay them back later. This is not an easy thing to do, but we all know those fundamentals.
No, my theory is not subject to the ups and downs, the peregrinations of the stock, the unpredictable peregrinations of the stock market. It's painful to do, but I think the idea of owning the stock market is the best approach to equity investing, and perhaps I didn't make that thoroughly clear there. I have never felt that equities should be the only portion of an investor's long-term program. I myself am about 50% stocks, 50% bonds, for example. I was brought up when I came into this business in 1951 with the Wellington Fund, which was and is, and I hope always will be, a conservative balanced fund. But I think the idea of buying and holding forever and not trying to make adjustments requires that you've gotten it right in the first place. That you can only hold tight if you've bought right, if you will. And that is to say, have an asset allocation that has something to do with how many years you have to accumulate money, how much resources you have at stake, how much income you need, and how much courage you have to ride out the peregrinations of the market. So you've got to take all that into account from that simple statement.
Well, of course, I've only been in this business for 57 years, and I have never seen anything like it in my life. I've never seen anything like the amount of speculation that's going on in the market, which is basically twice as much stock trading, twice as much turnover as we had in 1929, the previous high. We have these frequent days. We've had 37 of them in the last year where the market's gone up or down 2% or more. And when I came into this business in 1951, we might have had 3 or 4 days a year like that. 12 times as many wild and woolly days as history would have said. So we've taken the whole focus of market participation in our capitalistic system here in the U.S. From one of investment to one of speculation. And I happen to think that's a tragedy in which the investors are the losers, and which, of course, somebody's a winner. Wall Street wins. They make $650 billion a year in fees and commissions and all that kind of thing, which means that investors lose that much to the market. So it's a system that's crying out for change, although I never would have guessed the change would be so abrupt. I never would have guessed the speculation would have been so rampant. I never would have guessed that credit would be so easy. I never would have guessed that credit standards would be so devastatingly low.
Well, as my friend Jim Glassman quoted me in his op-ed piece in the Wall Street Journal yesterday, it's a quote I don't even remember where I made, but it said, I don't know anybody who has ever been successful in timing the market. I don't even know anybody who knows anybody who has ever been successful in timing the market. Last year, these last 2 years, the index, S&P index, has outperformed roughly half of the funds, a little bit less last year, just about half this year. I don't regard that as a significant long-term sign at all. First of all, the number of funds is not a relevant statistic. We use it because it's convenient. But if you've got a few little funds in there that do well, they count just as much as a few big funds. The reality is, no matter what the statistics tell you, indexing always wins. I say that because index is delivering the market return, and all those investors out there are by definition getting the market return themselves, less cost. So if statistics don't capture that index advantage, it will be corrected in the next year or the next year. And by the way, if you look at even the last 15 years, counting those last 2 years, the index has outperformed about 75% of all active managers.
Stock market is just a big gambling machine, and it's probably rigged too, so I don't invest.
In the short term, the stock market is a casino. That's correct. In the long run, it is not a casino. It's a machine for compounding interest and returns, which, as Einstein said, is the greatest miracle in financial history.
Yes, continue to invest. I've told particularly young people in the office who are really petrified by this market decline that it's the best thing that ever happens to him. And if you think about it logically, of course it's wonderful. I mean, think of, say, the young man I was talking to yesterday is probably 25 or 26 years old, and he's got the rest of his life in invest. And I said, well, let's suppose that Chris Scott, his name is, I said, let's suppose, Chris, that the market's going to end up at Jim Glassman's 36,000 by the time you retire. Do you want to be investing all your money when the Dow is at 35,000, or invest it all when it's 9,000? Just think about that for a minute. In other words, you want a long time to invest at low prices, and it's certainly a frightening advantage for those of us who have some money at work in the market today to think of this as a blessing. But it is a blessing because in the long run, investing depends on accumulating money at sound prices and not inflated prices like we have. I also think the general economy and the financial markets are well served by a return to reality. When you leave reality and depart from the laws of gravity, there's nothing but bad things that can happen, and the higher you fly, the more you fall. We flew quite high enough, and I think it's a blessing, maybe a blessing in heavy disguise, a blessing that we've come back a little bit toward the ground.